joined by a market expert, a prominent voice in the market, Sunil Subramanian. Now we have like an interim trade deal in place. Your initial reactions on it, and how do you expect the market to react on Monday?
Well, first of all, I think it was good that a tweet was actually followed by a actually signed document coming through. So it indicates that Mr. Trump has not changed his mind in the interim. Second is, I think market will take it positively because, obviously, India is a country which has a huge labor, huge MSME sector, and we are at a very low per capita income. So opening up of any other country, right? Obviously, the US is the largest economy in the world on a standalone, 25% of the world's GDP. It's a huge, huge opportunity for India. And initially, the market's reaction I suspect, would be more on those tariff-impacted sectors, right? Which have already seen a run-up post the tweet of Mr. Trump and Mr. Modi's acceptance of that. But I would say that the rally will get sustained. And one of the reasons for that is that a lot of the benefits are actually going to be outside of the stock market, right? So you're going to get the whole MSME, which is 40% of India's GDP, which is not represented in the stock market. So I would say that the few players that are in the stock market all the prices will go up just to take advantage of this thing. So their play there will be initially a big reaction, but over a period of time, it will settle down. And I see the broader economic benefits from the deal coming through and helping a lot of other related sectors. For example, MSMEs, if they benefit, there'll be more job creation. It'll drive more per capita income and consumption. So these are the things which are probably going to be more beneficial for the Indian economy, and the markets will start reflecting that. But yes, there are a couple of still questions not clearly answered in terms of the Russia situation and the access to Indian agriculture that we are giving, to a limited space.
Yeah, so we'll get to those questions. But right at the start of the year, Mr. Subramanian, I remember having the first conversation in the first week of 2026. And you mentioned how, you are still betting big on the mid-caps in the context of this deal, which specifically targets the large labor-intensive MSMEs. Do you think sectors like textiles, toys, mid-caps will now permanently outshine the large caps in 2026, given, the context of this interim deal?
They would definitely outshine over the next year or two, but to say permanently, because when FIIs return, they tend to prefer the larger cap spaces, right? They are not so much exposure to the mid and small cap. Domestic capital, DII money, will definitely shift away from large caps to mid and small cap, because the key concern there was the higher valuations related to large caps and the growth was not being seen. Even this last quarter's earnings, so far you've already seen small caps outperforming better than mid caps and better than large caps earnings. But with this impetus coming through in terms of the trade deal, I definitely would say that mid and small cap will get a fresh lease of life. And over the next year, 2 years, I definitely see mid and small cap outperforming large caps in that context. Because even if FIs come in a rush, I would expect DIIs to sell those large caps at profit to the FIIs and divert that money to incrementally to growth-oriented mid and small caps.
Absolutely. Now, tell us about the impact of not buying oil from Russia, because it's finally in print. It's not on, like a platform like Truth Social, but, it's coming from a valid source that we no longer will be buying oil from Russia. So in your view, how does this work? How does this math work for India?
From a political side, leave the political part of how we manage the diplomacy with Russia to Mr. Jaishankar but from a oil refining company's perspective, there are 2-3 things here. So one is that India already used to buy oil from Venezuela. Okay, ONGC has a joint venture out in Venezuela. So I think part of the US deal is for Venezuelan oil, because I think the US can't use Venezuelan oil, and Venezuela has been supplying to countries like Cuba and all that. That current, whatever is being supplied there, will get diverted to India. So India can usually use Venezuelan crude. The second is that we also have a promise in terms of the talks with Iran going through, right? Now, if there is a truce arrangement that comes through because that, and the sanctions on Iran are lifted, India has been, prior to the sanctions, a big buyer of Iranian crude. So I think these two sources will more than take care. And of course, we'll buy some American crude too. But the point is that ultimately, crude is also driven by the fact that I think the International Energy Agency says that there is about 3.7 to 4 million barrels of excess supply of crude this year. So crude prices are obviously going to be trending down. And I think we can easily substitute it with these. But on the diplomatic part, whether we are able to completely shut off Russia and how that's going to be handled, it's a political question. And I think that we'll leave that for the better powers that be to answer.
Absolutely, Mr. Subramanian. Thank you so much, and always a pleasure to have you on ET Now. Thanks for those inputs and insights. We are running short on time, but thank you very much. Well, on that note, it is time for us to wrap this edition of News Now. More updates to follow going forward.